Bookkeeping Basics, Double Entry Accounting. Welcome everyone. Today we are looking at double entry accounting, the foundation of modern bookkeeping. This system underpins how businesses of all size track money, measure performance, and stay financially healthy. My aim is to demystify it, show you how it works in simple terms, and help you understand why it matters, even if you use accounting software every day. Reasons: the birth of double entry accounting. Double entry accounting is not new. It dates back over 500 years. In 1494, Luca Pacioli documented this system, bringing structure and logic to financial record keeping. What's remarkable is that despite advance in technology, the same principles still drive today's accounting systems. This consistency is why accounting is often called the language of business. The concept: what is double entry accounting? At its core, double entry accounting is about balance. Every transaction affects at least two accounts, never just one. One side is a debit, the other side is a credit, and together they keep the books balanced. This dual effect is what makes the system so reliable and self checking compared to simpler methods. The foundation, the core accounting equation. Everything in accounting comes back to this equation: assets equal liabilities plus equity. Assets are what the business owns. Liabilities are what it owes. And equity represents the owner's stake. Every transaction you record must preserve this balance. If the equation doesn't balance, you know immediately that something has gone wrong. Rules, debits, and credits. Debits and credits often confuse people, but the rules are consistent. Assets and expenses increase with debits. Liability, equity, and income increase with credits. The golden rule is simple: every debit must have an equal credit. Think of debits and credits as directions, not good or bad. Practical example: buying equipment for pound 1000. Let's bring this to life with a practical example. If a business buys equipment for pound 1000 using its bank account, two things happen. The equipment asset increases. That's a debit. and the bank balance decrease, that is a credit. The total value of assets stay the same, which is why the books remain balanced. Benefits. Why double entry matters. One of the biggest advantage of double entry accounting is accuracy. Because every transaction has two sides. Errors and inconsistencies are easier to spot. This system also supports reliable financial statements, which lenders, investors, and tax authorities depends on. Most importantly, it gives business owner a true picture of financial health. Comparison: double entry versus single entry. Single entry accounting is simpler but very limited. It typically tracks only cash in and out without showing the full financial picture. Double entry, by contrast, capture assets, liabilities, and equity, providing far more insight and control. That's why double entry is essential once a business starts to grow or becomes more complex. Today, modern bookkeeping and software. Today, most accounting software uses double entry automatically in the background. When you enter a transaction, the system handles the debits and credits for you. Even so, understanding the fundamentals help you read reports, talk confidently with accountants, and spot issues early. The principles from centuries ago are still working for us today. Master the basics, empower your business. To wrap up, double entry accounting is more than bookkeeping. It's the language of finance. When you understand it, you gain clarity, confidence, and control over your business decisions. Mastering these basics empower you to grow sustainably and avoid costly mistakes. Thank you, and I'm happy to take questions.